Welcome to the Insightful Investor Podcast, a weekly series that seeks to share industry, investment, and market insights. Learn more about our show at insightfulinvestor.org. Today's guest is John Gray. John is President and Chief Operating Officer of Blackstone, one of the world's largest and most highly valued investment firms, managing nearly $1.2 trillion in assets. John began his career at Blackstone in 1992 as a young 22-year-old college graduate and has played a pivotal role in the firm's remarkable growth ever since. Welcome, John.
Alex, it is great to be with you.
Before we dive into your career journey, would you share some insights about your upbringing and the early lessons that helped shape your leadership style?
Well, my upbringing, I grew up in suburban Chicago. I actually had never been to the East Coast of the United States until I went to college. I mostly played sports, but I grew late, so I sat on the bench more than I would like to say. I did well enough in school, though, to get to the University of Pennsylvania in Philadelphia, and that was really important for me because there I met a bunch of young people who were highly motivated, particularly from the East Coast, and it excited me. I enjoyed school. I ended up getting a dual degree. I was an English major, and then I was also in Wharton in finance. And my senior year in college, in romantic poetry class, I met a young woman, and that has turned out quite well. In fact, next week we'll be celebrating our 30th wedding anniversary. So that was 33 and a half years ago that I met Mindy. And about a month after that, I was dropping resumes for jobs, and I got a job working at a very small investment and advisory firm at 345 Park Avenue, which is where I sit today as we do this Zoom call. So I joined Blackstone straight out of school. So my life was pretty set early on. I'd like to say I have the most boring biography of anybody you'll meet. Having met my wife and gotten my job senior year in college. And but it's been incredible. And in terms of my leadership journey, I would say I don't think I was somebody who sort of naturally came to leadership. I was probably a bit intimidated. I certainly wasn't comfortable public speaking. But I think just over the years, my ambition to succeed, my drive, constantly put me in positions where I had to do these things. And what I learned, I think, in leadership is if you're sort of willing to go all in, if you have a clear vision of what you want to do, if you treat people in a good way, people are willing to follow and work with you. And so I would say my leadership style has evolved sort of from doing. And maybe as I've gotten older and even more mature, manage more and more people, I think you become a little more of a student of the game. But I would say it wasn't something that I was sort of born with. I would say it was an acquired skill. And it came from, I think just being at this for a long period of time. And then to this point now, I actually enjoy it. And I get a sense now of the power of being able to lead an organization and to do things. And it's one of the fun parts of my job.
Were there any major leaps in your development and growth? If you look back and analyze any pivotal moments in your career?
Yeah, there were definitely a few. I mean, when I started, I was in our M&A and private equity business for the first year, which was unbelievable training because I got to learn a lot about the LBO business and discounted cash flows, looking at companies, public markets things. And then the real estate business had collapsed, and our visionary founders, Steve Schwarzman and Pete Peterson, decided to go into that business. And they found a great guy in Chicago named John Schreiber. And there were no junior people on this. And one of my colleagues here said, hey, you should try this. And so I often say, luck has been a core competency. And in that case, it definitely was. And so we started on this journey of building a real estate business in the early 90s when prices were very cheap, things were quite distressed. And we got to ride that up through much of the 90s. Then there was a bit of a downturn after the dot-com bubble. Then there was obviously post 9/11. And then as the Fed lowered rates, it created a new environment where real estate pricing started moving up a lot, and the commercial mortgage-backed securities markets evolved. And we had this insight, I guess I had this insight that rather than competing for individual real estate assets, which were starting to become very pricey, what if we went and bought big public companies? And we went out and ultimately bought a whole series of public companies, most notably equity office properties for $39 billion and Hilton hotels for $26 billion. And that was obviously, that whole experience was very important. And then, of course, probably the most formative for all of us who were investors was the financial crisis. Watching everything you'd invested in, watching markets collapse, debt markets shut down, the economy slow dramatically. And fortunately, we made a bunch of good decisions prior to that. We were able to ride out that storm. And the decision at the time when I was running the real estate business to expand rather than sort of pull back. Go out and grow our business more globally, move into debt, move into different forms of core plus real estate, and acquire a bunch of talent at a time when a lot of companies were laying people off. That turned out to be a very good decision. And we made some big pushes into logistics and single family homes and so forth. And we fought to protect some of our old investments, notably Hilton and equity office. And that was very formative. And then related to that, I would say what I learned was this idea of trying to find really good neighborhoods, that the investments that did well through that crisis were ones that had long-term tailwinds. And so that became very informative later in my career, certainly in this job. And then the other big thing I would just point to was when I got this job now 7.5 years ago and had the opportunity to help oversee day-to-day, working closely with Steve Schwarzman, the firm and all these different businesses we have in private equity and credit and infrastructure and hedge fund solutions and life sciences, secondaries. It was an incredible opportunity, but it also was very daunting. And yet I would say for me, the intellectual challenge of it, being able to see even more of the world, more investment opportunities, to really understand what's happening with technology and life sciences, that's been incredible as well. So every step on the journey you learn. I will say, and you know this, Alex, you tend to learn more when things go badly because you really study that as an investor or as a manager. But I would just say I've enjoyed it. But it can be hard, as you know. I mean, COVID was a learning experience, certainly when you shut down the global economy, you have a bunch of businesses that no longer have revenue. The sharp upward movement in rates the last few years was another challenge. And you're constantly learning about how can I be a better investor? How can I manage through crises? And how can I ultimately deliver for our customers?
The part of what you just described that stands out to me as you go back 30 plus years and look at those pivotal moments is you were buying in general when others were selling. And in hindsight, you can look at that and say, of course, things were cheaper and it was obvious. But I know as you live through that, it is, as you described, daunting. But my question for you is, was the answer relatively clear to you, or did you really have to question whether you wanted to take that step?
Well, the answer, always in hindsight, it looks a lot clearer.
Of course.
But when we started buying single family homes after the crisis and the prices had fallen, and I'll never forget, I was driving around with my father in suburban Chicago, and we were going around and we're seeing the prices you could buy homes. And I think we were both shocked at how much they had come down, 30, 40% from where they had been. And so sometimes a light bulb goes off. Sometimes you go to a place, you're in India, you see what's happening, you see the rise of physical infrastructure, capital markets, legal infrastructure. You could see the talented people and say, hey, I think this is really going to take off. This is a neighborhood I like. To your point about doing it out of cycle, that is hard. I mean, because, the natural tendency is to say, this is the thing that's delivered me great results the last 5 years. So I'm going to do more and more of that. And this gets to the importance of diversification, but also recognizing some of these things have cycles. So if something has performed incredibly well for 5 years, it will tend to draw in more capital, which sometimes can drive down the excess returns. And those things that are unloved, nobody's paying attention to, and you can buy them at a better price. And so, obviously you wanted to be a tech investor after the dot-com bubble. You could have bought some of the greatest companies in the world today at incredibly cheap prices, but it just seems really hard. And I think as an investor, you do need to separate sort of the cyclical from the secular. So if you think about the secular, what's a buggy whip business? Is it landline phone companies or department stores or legacy cable businesses that are facing maybe long-term secular decline? Their values may come down, but there's not some pop. There are other things that are obviously more cyclical in nature. Commercial real estate's a great example of that. And therefore, after the prices decline, ironically, of course, that's the best time to invest. So I would say it does take the courage of your convictions, and it takes having, I think, been through this a few times to recognize that most of the best opportunities happen when the prices come down the most. The risk is the greatest in 2000, in 2007, and 2021, when no one perceives risk. Today, when they're reading all the headlines and they're worried about tariffs and geopolitical things and so forth, actually, you're generally paying better prices for assets. And so you're more inclined to lean in. But I think if you want to be someone who delivers outsized returns over time, you have to sort of put that into your DNA.
When you joined Blackstone in 1992, the firm only had about 75 employees and 750 million in assets. Today, you're nearly $1.2 trillion and obviously grown significantly. How would you say Blackstone has improved with scale, and what challenges has this significant growth introduced?
The challenges, I'll start there. Obviously, when you get larger, you have to become much more intentional in how you communicate. And you can become siloed. You could potentially become bureaucratic. You could become just a bunch of little fiefdoms in different asset classes and geographies around the world. And I would say the firm has done a remarkable job of fighting that. There's such a desire to do extremely well in everything we do, particularly delivering for our customers in terms of returns, that we realize we're best if we stay connected. If we share the information and data we're seeing across our portfolio companies, could be insights on trends, could be what's happening with inflation, but we still run the business like a small firm, and we stay in regular contact with one another. And so I would say we've done a remarkable job of maintaining that spirit of ownership and fierce dedication to being successful. And the other things that have stayed constant over the period of time, just a relentless focus on delivering for returns for the customers, because that's what it's all about. Always operating with integrity, because as you know, we're in the trust business. Nothing else really matters. We've got to make sure we honor our clients' trust. We work at the highest standard in everything we do. We have this constant focus on being an entrepreneurial place, because one of the challenges when you get bigger is you start to lean towards process and less towards creativity. And you can't have all creativity, but it's this idea of you've got to create this amazing energy with talented people looking for the new idea. What's AI going to change? What's going to happen to energy? What's a new geography? And then you have this control structure around it. And we, I think, have done a very good job of balancing that and continuing to innovate in terms of where we invest and also who our customers are. This expansion beyond institutions to insurance companies to individual investors. At the core of everything, though, is we have maintained the culture that I sit here where I sit every Monday doing this Blackstone TV, along with Vic Sawney, who's our Chief Administrative Officer, Steve Schwarzman. We talk about what we're seeing in the world. We talk about what are the trends, what the firm's doing, how we're giving back. And then we actually have a photo contest where this last week was graduations and proms, because we want to keep the place connected. And so it's definitely grown. I would say it's more challenging in some cases to operate. There's a lot of focus on what we do. So there are press and political considerations you have to take into account, which is another dimension in investing. But at its core, the business has stayed the same. We have to do a great job for our clients. We have to have great and rigorous process, and we have to stay unbelievably connected in what we do. And I think everyone who comes here is amazed that despite what you think of this huge $180 billion market cap company is still run a little bit like a small business, because we really care. We really want to do an amazing job.
One of the advantages of scale that's probably less talked about is you become a magnet for talent. And people want to work at Blackstone. They want to learn from all the insights that you have. And that gives you the opportunity to be adaptable and innovative. But it sounds like you have to be very intentional in taking that opportunity and catalyzing and taking advantage of it.
I agree with that completely. I mean, it is a great point. When I joined Blackstone, you have to go to the meetings and tell people who the firm was, right? And now everybody wants to come here. Obviously, I know lots of people who have children and they want jobs and this sort of thing. And it tells you that we've created something special here. Obviously, we have a great process around. We have to have this place run as a meritocracy. So we got to have the best people. But then once they get here, you've got to make sure they still feel like the place is a meritocracy, that they can benefit. And then to your point, we've got to find ways to share the information, either using technology or in our various meetings we host every week, so that we're sharing the insights we have. Because even, if you have a lot of great talented people, if you don't have great process, great systems, you can lose the benefit. And so to me, it's all that intellectual capital that's shared, so that if we know an industry, in private equity, somebody can help us evaluate a credit investment, obviously subject to legal limitations, company names, all sorts of things. But there's a lot of value in terms of the insights and what we see. And so, yes, I think one of our great advantages of scale is just having more data and more insights globally. And then being able to connect dots to say, hey, I see this trend that's happening in the United States. It's beginning in Europe. It hasn't even started in Asia. How can we capitalize on that?
It's interesting when we look at your different segments of your business, private equity, credit, and real estate divisions are now roughly similar in size. Was this diversification intentional, or did it naturally emerge from market opportunities?
Well, I would say the diversification was definitely a decision Steve Schwarzman gets credit for very early on, well before others, I think, in the alternative business saw that there was a benefit to serving clients in a multitude of ways. I think how it's developed, the fact that they've all gotten to roughly the same size, I'd say is more coincidental. And sometimes there's an ebb and flowing. Today, credit obviously is growing more quickly than, say, real estate. Different parts of private equity, infrastructure is in a very fast growth mode right now. But these things change based on cycles and so forth. And I think one of the strengths of the firm is by not riding just one horse. And by the way, not just riding one geography. We had our 25th anniversary in Europe a couple of weeks ago. Having multiple places, all different sectors, we think it makes us a better firm. And when I look today at one of our great advantages in credit, it's that we have so much insight coming from our equity business. We have so many great relationships with financial institutions. And so we're trying to use the power of scale to see the world more clearly and to capture more opportunities. And definitely doing it at size for us has certainly been helpful. But the fact that the three biggest units are all basically the same size, I would say a nice coincidence.
Mm-hmm. You touched on this earlier, but about 3/4 of your assets are with institutions. Do you see this mix evolving over time?
So I will break it down one step further. So it's a little over half, probably, 55% is from what I think of our traditional client base, which has been pension funds, sovereign wealth funds, endowments. Today, about a quarter of our assets comes from the private wealth area, from individual investors, and that has obviously grown a lot. And about, I think 240 billion, 20+% is insurance clients, which is a newer area. Most of it focused on investment grade private credit, where we're originating credit on their behalf instead of liquid fixed income, and they get a premium. I would say all three segments continue to grow. The rate of growth is higher for the individual investors and the insurance companies because they're earlier in their journeys. So if you think about our institutional clients, our pension funds, they're already a third or higher allocated to private assets because it's been their best performing asset class. And almost all of them are staying at that level. They'll grow, but obviously there's some limitation because they need a certain amount of liquid assets. When you look over at individual investors, the folks you serve, they're on average probably low single digits. Maybe at a firm like yours, it's higher, but on average, low single digits allocated. So there's still plenty of opportunity for that to grow. And the insurance companies, I would say, have moved a fair amount over time in real estate and commercial real estate lending on the private side, but in all sorts of asset-based finance, could be fund finance or infrastructure, energy, consumer finance. This is a whole new area for them. So that's growing very quickly. So all three of our main engines are growing, but those last two, the individual and the insurance company, are growing faster just because they've come to this later. But what's encouraging to me is virtually all of our clients are happy with alternatives and want at the very least the same, or in most cases want more. And that's why when I think about a great neighborhood, I definitely think the business we're in is a great neighborhood alternatives.
And obviously Blackstone has been instrumental in democratizing alternative investments. What would you say is next for this trend?
Well, look, we've been at this now for more than 15 years. It started with our drawdown funds. We built out a whole team, as you know, to service the individual investor. We created these semi-liquid vehicles. It started with BREIT and then BCRED. We've gone on in private equity and infrastructure, multi-asset credit, all these areas. The basic idea has been, can you create something that works for individual investors? So do it in a perpetual structure instead of drawdown. Provide semi-liquidity, not the same as what you can get in the stock or bond market, but much shorter duration than what you get in a 12-year drawdown fund. In some cases, there's greater tax efficiency. They're just easier to access. I think what we've shown over time is we can produce a premium to liquid markets. And as a result, I think these types of structures for us and other firms will continue to grow. I think the next stop on this journey is, we'll begin to see different modules. Potentially, we've announced a collaboration around liquid assets with Vanguard and Wellington, where we're putting together active equities, passive equities, liquid fixed income. So certain investors can in one-stop shopping get privates along with those with best-in-class managers. I think we'll see more of that. I think you'll see a firm like ours sell or put together more of our products in one place as an offering to make it easier for customers. I think there will likely at some point be the introduction of private assets into defined contribution plans. Today, as you know, if you work at a state pension plan, you may still have you'll still have defined benefits and private assets, but most private employers only have 401ks, which historically have not allowed private assets. And as a result, most of the population outside of the wealthiest have not had access to the performance that privates have delivered over time. I think you could see that as another frontier that emerges. So to us, it still feels like it's a ways to go. And like anything, it's got to be performance driven. I mean, it's no different why we've seen the rise of ETFs and index because of the performance. It's why the alternative industry has grown. If we're able to give premium returns, I think the business will grow. And certainly on the individual investor side, it feels like it's early days.
One of the big topics these days is AI. How are you incorporating artificial intelligence into Blackstone's operations and investment strategies?
Well, I think it's the most important thing, Alex. We could talk, it's funny, everybody worries about, what are the tariffs? Will the Fed cut next month, whatever? The big thing is the AI. That if you went back in time and you said, what happened after they introduced the railroad or the automobile or the internet, you saw a step function increase in productivity and growth. And in my mind, we're absolutely on the cusp of something like that. I think it will change so many businesses when you add super intelligence at almost no incremental cost other than energy. And so for us as a firm, this is the question. We've been talking about, we have an operating committee offsite, and we're talking all the time. And the topics are, what do we do as it relates to investing? What do we do with our portfolio companies? And what do we do at the firm level to make sure we're thinking about AI and its impact? And so to your question, and on those topics, I would just say on the investing side, we've done a lot on what we call the picks and shovels. So we've become the biggest investor in data centers in the world, which has turned out to be a very prescient decision by us. And has created a lot of value for us in our real estate and infrastructure areas. We've made enormous investments in the energy and power space. We just announced the privatization of a public utility in the southwest of the U.S. We're investing in all sorts of electrical equipment manufacturers, utility services, because if you think about the data centers, you think about autonomous vehicles, you think about the robots, they're all going to use electricity. And so these are big trends being driven by AI. We're also spending a lot of time talking about both on new investments in our existing portfolio companies. How can you AI businesses? How can you take companies that have rules-based systems and introduce AI to improve productivity? How can you make customer engagement better if you have call centers and things? How can you use these tools on content creation? Coding at our companies and at Blackstone is becoming much more augmented reality, basically utilizing AI. I would just say we're thinking about both the positive impact, and when we survey our CEOs, 85% say it's going to be a positive. I'm not sure it's going to be a positive for 85% of the companies, but we want our companies thinking about how we can adopt this technology and make the businesses better. We just hired Rodney Zemmel, who ran at McKinsey AI for them. It gives you a sense of our mindset of the importance of what's coming. And it won't change everything. The apartments, the theme parks, they'll still be going to Jersey Mike's will still be the same experience. But almost every business will be significantly impacted. We recently bought an accounting firm. I think there's enormous opportunity. That's a great example of a rules-based business where there could be enormous efficiency gains that come. So I think as investors, it should give you a lot of positive feeling that there's going to be, I think, the opportunity for earnings to grow, the economy to grow, margins to grow, and that'll be a positive for share prices over time. But not every company is going to be a winner. I would not advise your child to grow up to go into the translation business, let's say. This technology is going to change a lot. And we have to, if we're going to outperform for our customers, we have to figure out how to utilize the technology. I mean, we're doing all sorts of stuff, scraping the data we get at Blackstone. We're doing summaries of the board packages, looking for words that are being used. We're trying to find this information, share it. Back to your point earlier about the benefits of scale, we can afford to invest in a team of 60 folks in data science and AI to help make our company and our portfolio companies better. And I would just say, to me, this is the most important thing.
And the way I think about AI, just from a high level, and I'm curious if you agree, is there are certain things that humans are better at. There are certain things that AI is better at. And so it's important to figure out where those lines are and make sure you're on the right side of both. And then humans plus AI doing the things that they do best together should be extremely powerful and productive.
Yeah, it's funny. I haven't thought about one side necessarily being better, but I do think you often will need this. You're going to need a human oversight on a lot of this stuff. And there are some things that humans maybe for a long time will do a lot better. I do think it's going to enhance experiences in a lot of ways, right? I mean, just things that are two-dimensional and pretty flat. By the way, just doing searches today on ChatGPT versus, doing traditional search is pretty different. And what you can learn if I have a meeting with somebody like you, I mean, the picture that's drawn is so much more complete. So I think for us, again, I love doing the picks and shovels because I don't necessarily know who's going to win the game. But we've got to figure out how to apply this technology to businesses we own and businesses we're going to buy. And we have to avoid things that are going to really be disintermediated. And I would tell you almost every single investment committee discussion, there's some focus on what is the AI impact here? How have we accounted for that in our underwriting?
You've interacted with many great leaders globally. What attributes define exceptional leadership in your view?
I think a great leader just has a clear vision of where they want to go. Now, they may change that, but when you're leading an organization, it's just so much better when you know we're going to take that hill. That sort of clarity of vision, I think that's top of the list. And then I think somebody who has this relentless desire to win, to be successful. So we're going to take that hill faster than other people are. We're going to do it more efficiently, different costs, whatever. That to me is really important. That sort of just drive, that will to win. Somebody who can rally other people. To me, when you see that, people want to play their hearts out for somebody because nobody can do these things alone, right? I mean, you're working with incredible teams. When I think about the gift of my job, the human beings I get to work with, it's incredible. So if you can have this clear vision, you're willing to put everything into it to go get it, and you want to be successful, and you can get others to come with you, that to me is a very powerful combination. And you just can't be, I think, when I see the people who are the greatest in sports or music, politics, they're just not satisfied. There's a level around these people where you meet them and you get this raw drive and hunger. And yeah, they've won 5 championships, but they want to desperately win a 6th championship. And that to me is the commonality. And somehow they're able to rally other people to what they're doing. And when you find that set of skills, to me, that's really special.
Because there is no top of the hill.
There's no top of the hill. Now, sometimes people who are really good at this often don't stop and pause and celebrate, which can be a weakness of these folks. And I can relate a little bit to that part. But if you have this idea that, going back to our earlier conversation, Blackstone started with nothing, $400,000, has become this enormous company. And yet we're constantly like, hey, a competitor's doing this, or we made a bad investment in this area. Why did we make that mistake? How do we fix it? If you sat in our boardroom, you would think we're a failing company, Alex. You would be like, what is wrong? Oh my God, this sounds like a terrible business, because we are so relentlessly driven. And this really does come from Steve. Like, we must be better. Like, what are we not doing? How can we be better at that? And that quality that pushes everybody to be their very best, to care about every detail, to want to win. That's when you have a really special organization, when you have a leader at the top who I think is pushing that way.
Because it's not about the destination. It's about constant improvement and the journey.
It's constant improvement, because you're like, yeah, we did all these things right, but you know what? We didn't do this well. So we're going to focus on this. And I think it's fun to be part of a place that strives for excellence in everything they do. And by the way, you're an investment organization, so you obviously have to have great investment results, but you want your legal and compliance to be the best. You want your accounting to be the best. You want your IT to be the best, your HR, your corporate affairs, running videos, whatever it is. You want everything to be the best, and you're constantly looking to improve on what you're doing. And what that also does is the danger as an organization has become successful is it becomes static. It doesn't adjust as conditions change. And if you have an organization that is sort of fundamentally unsatisfied, then you will push further. You then, when conditions change, you're used to looking at the mistakes you've made. You're used to making changes. And so it's almost like a building that's designed with a flexible structure versus, just like this, because then when the earthquake comes, it's in real danger. I think an organization that's not satisfied is better able to adapt when conditions change. And that's what certainly we try to do here.
And when you look at history, it certainly supports that. When you look at the giants of the past that became so big, they lost adaptability, they lost innovation, and eventually they shrink and go away.
Yeah. And the world changes. There's almost no industry. There may be a handful, but what were great businesses, phone books, newspapers, supermarket, right? Like whatever the business you'd said when I started in the business, you'd say, oh, those things are monopolistic. They've been around a zillion years. You could just own them and go to sleep. In many cases, they don't exist. I think about the taxi medallion in New York City, right? For 80, 90 years, they went up every year because the number of taxis in New York was fixed. And the number of people who worked and visited kept going up. Okay, great. One day Uber comes, value falls in 6 months by 90%. So if you recognize the world has this kind of capacity or likelihood to change, then you as a business or organization, you've got to constantly be thinking about, what am I missing? Is the market changing? Is a competitor doing something? And that's the way we think about it. And I think there is a real danger, particularly with organizations that have high degrees of success, that they sort of say, we made it. This is it. I can now golf 2 days a week. No problem. I don't need to travel so much. It's all good. The phone will ring. I got this. And I think you need just this relentless drive to keep going.
Are there any aspects of effective leadership that you feel are often overlooked or maybe counterintuitive?
It's funny. I think people sometimes, and this is certainly something I learned, don't realize that when you're in a leadership role, how much everybody's looking at everything you do. I'll never forget, I was sitting in one of the meetings with my partner, Kathleen McCarthy, once, and she said to me, what do you notice about all the young people at the table, everyone? I'm like, I don't know, whatever. She said, the guys are all wearing blue suits and blue ties. And I said, I guess I wear that. And she's like, yeah, Dodo, hey. And the power when you're in a leadership position, I always thought you could only touch the people directly around you. The reality is there is this multiplier effect. So if you make it a goal that you're going to respond to every email before you go to sleep, even if you can't read everything, like, hey, thanks for that. And to me, it shows a sign of respect to the people who sent it to you. It shows you that you're in an organization who cares about timeliness, responsiveness. If you're doing that and you're pretty busy in your job, then the people beneath you will think that's important, and so on and so on. And so I think the example you set as a leader is more than folks recognize. And you don't need to be the CEO. You can just be the leader of your small team or whatever else. People are going to look at you, how you do things. And so I think that power to amplify what you do is the thing that I didn't fully appreciate. It's something I've realized more and more over time.
You've mentioned the phrase, I've heard you say it a few times, stay calm, stay positive, never give up. How did that mindset help you navigate tough times like the 2008 financial crisis and inspire confidence in your team?
The genesis of this goes back to when I was raising my kids. I have my wife and I have 4 daughters, now all in their 20s, and I sort of came up with this phrase because sometimes people would get a little worked up, and it became what we called the motto in my family. And I basically kept it to myself, I would say, and my family. And certainly, if you go to the financial crisis, it was important to me, this basic idea that don't get too worked up. You've got to have a clear head. The situation looks tough, but there's always a way to get out. If you stay positive, it doesn't mean you think trees grow to the sky, but you just have this sort of core belief that there's a way to get out. There's some light, there's a pony in there somewhere, there's something. And then just this idea of never giving up, because you see it so often in people's lives, in sporting events. You just keep going at it. And something will eventually break your way. There'll be a cyclical change and so forth. And I would say maintaining equanimity and positivity, certainly during the financial crisis, was incredibly important. And really, I sort of crossed the Rubicon of spreading this gospel a little bit, I'd say, after or during COVID, where everybody was sent home. We started doing these Zoom calls with everybody. And I said, it's funny, this is what I say to my kids, but I need something, because everybody was they were facing health challenges and education challenges for their kids, and they were worried about their parents. It was a very tough time. And so, yes, now every Monday when I sit here and do Blackstone TV, I sign off with stay calm, stay positive, never give up. And it's become a little bit of a thing here at the firm. And I don't know, it's sort of core to who I am. And it speaks to the way I think about things. And what's funny is, in the investment business, things always go wrong. There are natural disasters. There are things that happens in markets. You can never anticipate. So I think it is so important to maintain calmness and positivity and keep going. I don't know. For me, it's been super helpful in my career. And like everybody, look, when it's hard, when you were in the bottom of the financial crisis and you've written things down 70, 80%, the last few years when rates went up and you face different challenges, you can get discouraged. But I remind myself, hey, there's a way out. And my experience has been, if you're really smart, you're relentless, you just don't give up, something good will ultimately happen.
What would you consider to be your superpower as a leader?
Positive energy and optimism. Most people, they show up at meetings and, there's a level of very serious or people are very sober. And obviously, I'm somebody who works hard. I read the materials. But when you sort of show up and you bring a level of optimism, I think it gets people excited. And people are more capable of achieving their potential. So, yeah, definitely for me, optimism.
Blackstone's success has not totally, but by and large, coincided with an extended period of stable and low inflation and falling or low interest rates. Obviously, markets are potentially facing sustained higher interest rates, greater inflation volatility, conditions that we haven't seen for some time. How does Blackstone plan to adapt to this type of environment?
Yeah. Well, it's interesting. If you go back over 4 decades, there have been periods, although most of that trend was downward in rates, there are obviously periods of rates moving up. Certainly in the 1990s, we've seen different economic climate. I still think the basics of finding great assets to invest in, understanding the mega trends, what's going on in the world, putting in place terrific management teams, adding value to businesses, innovating for customers, extending credit where you think you can get an attractive risk-adjusted return. I think the basics apply if the 10-year Treasury is 2% or if it's 6%. And what we're trying to do here, of course, is produce a premium to public markets. So if rates go up a bunch and it impacts asset values, the key for us is, can we do better than public markets? And I believe we can. And so I don't think it's about the absolute level of rates. It's about the performance we deliver to the customers. To me, that's really the key thing. And on the rates environment, the only thing I'd say is the inflation trends are still pretty good. We may get a little bit of a goods inflation spike. Interestingly, if you stripped out shelter, where the government uses lagging data and says that rental costs are growing at 4%, even though they're growing much lower than that, you would see inflation is already under the Fed's target. So I actually think we'll see easing by the Fed. And I feel a little better because the inflation picture is good. I'd say the biggest challenge on rates, to your point, Alex, would be if we continue to run deficits at 6+% of GDP, will we have a very high term premium, meaning a very steep yield curve where people will want a lot of compensation for buying all those treasuries? And that is a risk factor. But again, wherever rates are, wherever the cost of money is, I believe we'll find better places to deploy capital and add value and ultimately outperform. And that, to me, is the key.
Would you summarize your basic economic and market outlook, let's say, over the next 3 to 5 years?
Well, it's hard to have a crystal ball that far, but I would say I am encouraged by the fact that I think we'll have less geopolitical conflict, because the last few years have been filled with geopolitical conflict. So, and it hasn't paid off in most cases. So I'm thinking we'll have less there. I do think we'll ultimately get this tariff diplomacy to settle, and it'll be in the rearview mirror. I do think inflation in most places around the world, we see it across our companies in Europe and Asia as well. Inflation is settling, which should allow the cost of money to come down. And I think this technology is the most important thing, back to the earlier discussion. And so that gives me probably a more constructive view. And I would say the prices of assets in most cases are reasonable. And this does not feel like a bubble period where you sit in conference rooms, scratch your head and say, gosh, how can people be paying this for that? So I would say, because of my confidence in technology, I think it'll be a decent period for investors. And also the fact that I think governments learn that inflation is painful for political leaders, and therefore they're going to want to keep inflation down. And that also is good for asset value. So the combination of innovation and innovation going faster and inflation coming down to more reasonable levels, to me, that's a pretty good dynamic for the investment world.
You alluded to this a little bit earlier, but thematic, or as you described, mega trend investing is central to Blackstone's strategy. What underappreciated themes or trends excite you the most right now?
Well, I definitely said energy and power may be appreciated more and more, but I think that is going to continue to be really important. I think there are going to be businesses that are, as I described, as sort of rules-based businesses, accounting, tax, legal, transaction services, where you're going to be able to take a relatively low margin, heavily labor-intensive business and turn it into something that looks a lot different over time. So I think that is definitely a trend that is worth keeping your eyes on. There are definitely sectors we love. We continue to love franchising businesses. I mentioned Jersey Mike's. We own 7 Brew, Tropical Smoothie. I've been the chairman of Hilton for 18 years. That's just those businesses that have great brands that can grow with no capital. We continue to love those businesses. There's a cyclical recovery in commercial real estate. It's funny, I was out at the Milken conference not too long ago, and somebody was telling me there was almost nobody who attended the real estate session, which, back to your thing about what's out of favor, I think that's an area that'll come back. And geographically, I think there will be some opportunity in Europe. I think you don't want to buy Europe as a macro call, but in the sectors, travel's a great example of that. In some of the pharmaceutical services, some advanced technology companies, there are opportunities. And we've seen, going back to the diversification comment, if you think about the total return in Europe for a dollar investor this year, between their markets up and their currencies up 15+%, the returns have been off the charts. I think Europe, it's not going to grow like the US, but I do think in certain segments. And then maybe the final geographic place, which has begun to get a little more attention, but I think has a ways to run, would be Japan. I think Japan, after 30, 40 years of being sort of frozen, is now really open to foreign capital. And you have a lot of companies who own assets they shouldn't. And that unlocking of value will lead to very high returns for equity. So we are constantly on the search for what is that new thing, and then can we find it and apply it elsewhere and do it in different areas? Can we do it in infrastructure? Can we do it in real estate, private equity, and so forth?
Alternatives have obviously become increasingly important in today's market regime. What role do you envision they will play moving forward?
I think alternatives continue to grow. I think the premium returns will attract more capital. It was a sort of very niche-y business that served a small number of customers and did a small number of things: private equity, real estate, private equity, opportunistic credit. And now the breadth of what we do is so much wider. The openness to the asset class has expanded. Some of the innovations we've made in bringing the asset class in a more user-friendly way have been very powerful. I think this grows a lot. If you wanted some numbers, I think the whole industry is $15 trillion. There's something like $250 trillion of stocks and bonds away from governments. Then there's infrastructure and housing, commercial real estate. There's a vast universe of things out there. So I think this business, which today seems very large, is equal to whatever it is, 6 companies in the United States. I think it can grow to be much larger. But I will say that you got to come back to first principles. We must deliver returns for the customers. That performance is what it's all about. And so no matter what we do, that's got to stay as our true north.
And I would suppose the interest in alternatives may grow if we do experience an extended bear market in equities.
I think the events of this year, what happened after April 2nd, where people realized they had so many chips in just one area, reminded them that there are benefits to diversification. What we talked about the huge run in Europe after Europe has underperformed so much, there is a cyclicality in some of this. There's a point at which prices fall so much for something out of favor that they become attractive. Things that are great could be priced too high. I just see it as alternatives. It could be as a result of volatility. I just think the basic business, what we're doing, the inefficiencies we can capture, the way we can add value, the way we can align management teams, I feel good about it. It's back to the earlier question. If it's a high rate, a low rate environment, we've seen all of it over the last 4 decades. And in every case, we managed to produce for our customers. So certainly the volatility this year reminded people it is good to diversify. And private assets, there's a reason why the biggest pools of capital in the world have a large amount of their asset base here.
One of those segments, private credit, has seen tremendous growth more recently. Do you see risks of a bubble forming in this space?
I don't, because when you think about a bubble in credit, you look at a few things. One would be losses mounting. If you look at default rates in our portfolio, for instance, of non-investment grade corporate borrowers, it's around 0.5%. At the peak of the financial crisis, I think broadly, non-investment grade credit had a 14% default rate. So, and our numbers are lower than the industry overall, but nevertheless, we're just not seeing the kind of defaults you would associate what you began to see in the subprime market back in 05, 06 as sort of a canary in the coal mine. We don't have that. We haven't seen excessive leverage levels. So if you went back again to private equity deals done in 2006 or 7, people were borrowing 75, 80% of the total acquisition cost. In the first quarter this year, I think our average loan to value on a private equity deal we lent to was something like 43%, so almost half. And the spreads, I think, are still reasonable. But, Alex, it is certainly possible that some of the very high returns, because base rates were super high and spreads were very wide, some of that excess return could go away. But I still think private credit will deliver a premium to liquid credit. But I don't see the kinds of excess in terms of people putting on leverage that they shouldn't, that'll lead to very significant credit losses.
And how do you think about geopolitical tensions in terms of building an investment portfolio and any investment decisions that you make?
Well, it's definitely another argument for diversification. But as I said earlier, I think geopolitical tensions probably go down. If you look at the Russia-Ukraine situation or Gaza-Israel, those folks who were the aggressors, I don't think it has paid off in terms of what they've done. And I think these conflicts are going to be resolved, my guess is, in the not too distant future. And I think most parties are going to realize that doing that has a very high cost. So we tend to look at what's happened recently, and so we're very nervous geopolitically. But I think this last few years hopefully will lead to less conflict. I think the big things to keep in mind are what's economic growth, what's going to happen to productivity, and then the fiscal situation is the other element we've talked about that is a little bit troubling. But net, as an investor, when I look at where prices sit today, when I look at how inflation has come down, and I think about these technological changes, that gives me a more positive view than you would read in the newspaper.
Spoken like a true optimist.
Absolutely. A realistic optimist.
Yes, a well-informed optimist. John, this has been really interesting. I hope our listeners took away as many insights as I did. So I appreciate you taking the time to talk to us.
Great questions. Love being with you, Alex. All the best. Thanks for tuning in.
Thanks for listening. We hope you enjoyed this episode. Please visit our website at insightfulinvestor.org to access past shows and learn more about our podcast. If you have questions, feel free to email us at info@insightfulinvestor.org. And if you enjoyed the discussion, please subscribe to this podcast to ensure you don't miss future episodes. And don't forget to forward today's conversation to others you think would enjoy listening. This podcast is provided for informational purposes only and should not be relied upon as legal, business, investment, or tax advice. All opinions expressed by podcast participants are solely their own opinions and do not necessarily reflect the opinions of Evoke advisors, their affiliates, or companies featured. Due to industry regulations, participants on this podcast are instructed not to make specific trade recommendations, nor reference past or potential profits. And listeners are reminded that securities trading, commodity trading, and alternative investments are complex and carry a risk of substantial losses. As such, they are not suitable for all investors. Listeners should be aware that guests featured on The Insightful Investor may have current or past associations with Evoke advisors or the host, including as an investment manager of a private fund opportunity by Evoke, or access through an affiliated Evoke fund, or as a client. Participation as a guest on the podcast should not be perceived as an endorsement or testimonial with respect to Evoke advisors, the podcast host, or their services. Similarly, the inclusion of a guest on the podcast does not imply that Evoke advisors or the host endorses the guest or any company with which they may be affiliated or employed. Evoke has neither paid nor received compensation from guests for their participation.